This is Ethical and Professional Standards. This is the reading on guidance for Standards 1 through 7. This is Standard 2, Integrity of Capital Markets, which has two components, material non-public information and market manipulation. Members and candidates who possess material non-public information that could affect the value of an investment must not act or cause others to act on the information. Let's start with the definition of public information and non-public information and material information. Later on in the CFA program, you're going to learn about a theory called the efficient markets hypothesis, which suggests that asset prices, like a share of stock, are functions of relevant and material information. And the interesting part of that suggests that when any piece of relevant and material information changes, it's going to have an impact on stock prices. And of course, the clear example of information that's going to have an impact on security prices is when information that was private now becomes public. And there's lots and lots of academic research out there that shows that stock prices react to things like a dividend announcement or a merger announcement or a change in executive leadership. Well, let's examine material information. This is any information that has the power to change the mix of information that is currently available about a security in such a way that the security's price is going to be affected. Additional examples of this information include things like periodic earnings, cash flows, free cash flows, innovative products, management changes, bankruptcies, mergers and acquisitions. Any information that is specific to a company that will impact its stock price is considered material. Now, what constitutes non-public information? Of course, a great definition is any information that has yet to be disseminated to the marketplace in general. For example, annual financial results, which include the annual report and the proxy statement, which includes tons and tons of information, those are considered non-public until they have been widely distributed. Press releases, online platforms, print media. I mean, back in the old days when I first started studying finance in the late 1980s, this came through the mail. Nowadays, we don't have to wait that long. I wonder if you guys have ever heard the rumor or the story about a wealthy banker who was working in San Francisco in the early 1900s on the morning of the great San Francisco earthquake. And during the initial stages of the earthquake, this wealthy banker instructed his assistant to get in contact with the government officials to inform them that there is an earthquake going on, but not before he told that assistant to contact his broker in New York City so that he could short some stocks that were certain to fall in price as a result of the San Francisco earthquake. So clearly the earthquake, as it was happening in San Francisco, was non-public information until it could somehow travel all the way over to the floor of the New York Stock Exchange. Of course, today, things like that don't happen. Here's the deal. In order for information that used to be private, for it to be considered public, there must be a reasonable expectation that the released information has a wide reach. And lastly, members and candidates will regularly come across material non-public information, especially when working with companies who have that non-public information. It's the member's responsibility to keep that information non-public. And of course, that information should never be used to trade for the member's personal benefit. Now, those of you who have examined the study sessions and all of the readings in the Level 1 CFA program will know that there are lots and lots of topics: economics, quantitative methods, corporate finance, derivative securities, investment analysis, alternative investments. And so the CFA program is going to train the candidates to show proficiency in those areas. This is a great skill set to have. And so, of course, members are going to have the ability to scour the information that's available to the public and maybe non-public, non-material sources to be able to issue a report or a recommendation. I like this concept of analysts generally knitting together bits and pieces of information. That knit together is a great phrase to illustrate the skill set that members will have, and being able to draw some really, really good and meaningful conclusions that they can pass on to investors or their clients through recommendations or reports. Now, the important thing to note is that in doing so, this is not a violation of this non-public information standard. This is all called the Mosaic Theory. And in order for the Mosaic Theory to be acceptable with the Institute, evidence must be collected and maintained and recorded. So make sure that all of the due diligence and the research that is performed during this quest for Mosaic Theory recommendations, make sure it's on record. What about social media? I mean, clearly, investors can get online and view a company's webpage. That's got to be considered public information. Information that's taken out of the newspapers or press releases, that's got to be considered public information. But consider the problems with social media, especially social media platforms that require memberships. Some of these memberships are quite limited. And so if there is a social media outlet that has maybe 100 members, and there's some private information that's being discussed inside of that social media outlet, there's probably no way that that's considered to be public information. So a member has to be careful in using that information for trading for his or her clients. Social media must not benefit a few at the expense of the majority. That's a good concluding sentence there. Now, the standard does not suggest that members must be experts in all different areas. Of course, members are going to reach out to people who know more than they do about an industry or a product. Of course, members are allowed to consult those experts. And of course, members are allowed to compensate them without violating the standard. However, this is important. Members and candidates are ultimately responsible to make certain that any information that they get from an industry expert, it must be publicly available. Now, there are lots and lots of members and financial analysts who are well known. They show up on television all the time. They're interviewed by national newspapers. And so any recommendation or report issued by one of these analysts is not considered confidential, even if that information released in the report can cause a significant stock price movement. Now, here are the recommendations. Encourage the issuing company to make material information public before acting on it. And this happens all the time. Analysts are regularly suggesting to the executive leadership team, hey, look, this information is valuable. The marketplace is going to want to hear it, and they're going to want to hear it sooner rather than later. Members and candidates should also encourage their firms to adopt compliance procedures to prevent the misuse of material non-public information. Full disclosure policies to ensure that the information is disseminated to the marketplace, and encourage their firms to establish firewalls. Here's an example. Anthony Ricardo assembles information on the stock of UA Company. Stock price is around $18, down from, about $50 2 years ago. Net loss on the financial statements of $48 million. Ricardo phones 10 different suppliers. Surveys customers in the garment stores. Okay, after a thorough analysis, concludes that UA is a strong sell. Has Ricardo violated material non-public information standard? Doesn't seem like. It states that analysts can scour the information for the purpose of issuing reports. Sounds to me like Ricardo worked really hard. Lots of due diligence, lots of research, talked to lots of different people, and made a reasonable recommendation. The second part of the standard is market manipulation. Members and candidates must not engage in practices that distort prices or artificially inflate trading volume with the intent to mislead market participants. So let's define market manipulation. I wonder if you guys know the story of the Hunt brothers back in 1980, tried to corner the silver market. They bought up lots of silver and they took lots and lots of long positions in silver futures contracts. So much so that they controlled about a third of the silver market. Well, when several people in the silver market became aware of this attempt, they tried to make that information public. In fact, there was an ad taken out in the national newspaper, and I think some reporters wrote about it. And so the consequence was that one of the futures exchanges changed the rules about margin requirements and margin calls. And so the price of silver, when it began to fall, the Hunt brothers faced a margin call and lost a lot of money. I think there was an estimate of about $1 billion. So that sounds a lot like market manipulation to me. So what do we have here? Practices that distort security prices or trading volume with the intent to deceive people or entities, damages the interests of all investors, lowers their confidence. So this is a theme throughout all of the standards that the member behavior should promote the interests of all investors and increase the confidence not only in the financial services industry, but in the investments market as well. Two types, information-based and transaction-based. Information-based manipulation is the distribution of false or misleading information as a means of distorting prices or trading volume. I wonder if you guys know good history lessons here. During the Roaring 20s, there was an introduction of leverage into the Middle America. This had never happened before. And so consumers were buying things like cars and refrigerators and even radios and ovens. They were buying this on credit. It was like the first kind of a credit card. And this naturally bowled over into the floor of the New York Stock Exchange. And so investors could buy stocks up to a 90% margin. And so you can envision a scenario under which financial advisors were recommending a certain stock to their clients and saying, hey, to pay $100 worth of this stock, all you need is $10. So that bumped up the price, and then that advisor could, who owned those shares, could sell those at a higher price. So information-based manipulation. You got to be careful about social media, as always. Creating many social media accounts to spread a rumor. I think this was more common when social media first came about, but nowadays it might be less common, but still a big concern. How about transaction-based manipulation? Making trades that would trigger a falsification in price-setting mechanisms. In the academic world, we tend to call these things noises. Noise moves prices away from their fundamental values. Think of the following example. Suppose two traders who are well-known traders who typically trade lumber. And one day they agree to trade lumber at a price below market value. And not only do they trade a bunch of lumber below market value, but they make this announcement and they tell everybody and they say, oh my gosh, look at this price, it's so low. And so then that influence then allows people to think, boy, maybe the price is going to go lower. And so lots of people start selling their lumber before the price falls. But maybe these traders had large short positions in lumber futures contracts. And so they make a trade in one market and then they benefit from the underlying value in the spot market to make a profit in the derivatives market. The second part of this is that it's natural to think that smaller firms are more easily manipulated. I mean, if you think of a company like the Hershey Company in Pennsylvania, those shares on the New York Stock Exchange, the trading volume every day is 1 or 2 million. If you look at a company like Procter & Gamble, they average maybe 8 or 10 million shares a day. A company like Apple, I mean, it's 25 or 30 million shares a day. So large firms, probably not a good target, but smaller firms are much more easily manipulated. And that is standard 2. Standard 3, duties to clients and prospective clients, is up next.